When you're looking at a price chart and we set the fundamentals of the asset aside, where is the best place to buy? On a chart like this is Apple, by the way. It is one of the most widely traded equity in the world. It has extremely high liquidity and less prone to being manipulated by various means. And so on a chart like this, some people say the best place to buy is high because the trend is currently up and is likely to go higher. Others will tell you to wait for a pullback before making an entry. So it could come down to maybe around the 210 mark, and you can look to make an entry somewhere there. But the truth is, there's really only one rational point that objectively is the best place to buy. And once you see it, you'll never look at charts the same way. That point is where you're taking on the least possible financial risk for the maximum potential reward. And I call this the junction point. There can be small junction points locally, and that's where day traders focus on. So right now we're on the monthly time frame. If we go down to the daily, there's a junction point there. There's another one somewhere here. And another one there, and so on. But if you zoom out back onto the maybe weekly or monthly time frame and study the historical price action, you'll find that there's really only one, maybe sometimes two junction points that really matter. That's the spot that seasoned traders and investors wait for. These setups, they don't appear often, but when they do, you need to be ready because every serious trader investor will be watching the exact same level. Because of this, it's as if there are magnets attached to these levels because that's where majority of the capital injection is taking place from the market participants. And so, like we said earlier, on the local time frame, you might see a junction point along this uptrend, but in reality, the junction point of Apple's chart structure as a whole is somewhere around here. So why is the junction point so powerful? It's because it's the lowest point that the price can go to while still maintaining the market structure. Technical analysis at its core is actually very simple. So if I go up here, for a bullish trend, it's about making higher highs and higher lows. So there's a low, and there would likely be a higher low. There's a high, and then it made another higher high. And if I were to flip it upside down, it's the same thing for a downtrend. It's making lower lows and lower highs. But for this example, let's stick to the bullish case. If we're in this moment here, the price can technically go down all the way as long as it doesn't touch the start of the uptrend, which lies here. The macro structure is still intact. Most beginners try to identify these levels on a small time frame and look to hold on to their positions long term. So that is a very common misconception. So what they would do is, so like I said before, we're on the monthly time frame. Let's clear everything. They would go down to, say, the daily time frame. Look at this chart here. Try to identify the lowest junction point, which would be here. Even if you know this, by the way, you're setting yourself a lot higher than majority of the traders. A lot of the traders and investors, when there is a pullback from 250 to 230, they would think that this is a good buy because it pulled back for 10%, and they'll make an entry. So even if you buy at 204, you're well ahead of the herd. But you can actually become even a better investor by zooming out and looking at the macro structure. So we go back onto the monthly time frame where each candle represents 1 month of price action. And here we can identify where the true higher low sits. So if we analyze, there is a low here, then we have a low here, another low here, another low here. If you are a midterm investor, you can go for a trade where you look to find the junction point of this uptrend and buy somewhere along this point. And that can be okay. But if I had one place that I'm looking to buy as a long-term hold, then for me, I would wait until the price comes down to this level here. My buy area would be somewhere along the lines of this area. So let's think about why. If we look at this whole uptrend structure, the uptrend started here, then it moved to here, and currently jumped up here and one more time. So there's 4 higher low structure. And this level here has actually been touched already by the price coming down at this point. So from a technical analysis standpoint, it's actually very unlikely that the price will come down to this area to maintain a macro uptrend from a low here to a higher low here. What's more likely is that if it comes down in the future, then it would pull back to this box here because it's a fresh range that has not been touched. Now this is another concept that is a stepping stone. I wasn't really meaning to go into this for the preview, but it sort of allows you to foreshadow the other concepts that build on top of this fundamental principle so that you really understand what is going on in the charts. So if we clean everything here and go back to Apple at this moment, these junction points are created for a particular uptrend. So here is one uptrend here, you could see it in the green candles, and you could see the price is coming down and touching the junction point of this uptrend here. And similarly, it makes another uptrend, and the price comes down and touches again at the junction point over here, which allows the price to continue to run up. Now if we move further up, it's the same story over and over again. It's the junction point of this uptrend that the price taps into. If we take out the replay tool and you're in this moment here, you could argue that objectively the best place to buy actually is still down here, because the price can still come down all the way here and make and continue this low, higher low, higher low, and the 4th higher low over here. So by buying here, you're taking on additional risk, and that's something that you have to be mindful for. And you can see that this zone continues to be active even in today's date. And this exists on all time frames. If I go down to the weekly time frame and spot an uptrend here, you can see that the price taps really perfectly into the junction point of this uptrend. And if we even go down to the very small time frames, let's say the 1 hour, you can see for this uptrend here, the price comes down and touches near the bottom of the move. Same thing for here. For this next uptrend, the price comes down exactly to the start of the next junction point, and this cycle really continues. And even when you look at shorts on the other side, there is this prolonged downtrend, and you can see that the price comes up and has a bounce down from this area before it breaks the microstructure. So this concept is applicable on all time frames, but as an investor slash long-term trader looking to make well-rounded, good risk-reward plays, you're looking for opportunities of these higher time frame junction points. So to wrap up this concept, we go back on the monthly time frame and discuss a little bit further on why this is the best, okay? So if the price comes down for whatever reason, there's no guarantee of it, especially how far Apple has extended past this range, but theoretically there could be another junction point down here, but I think it's extremely unlikely that Apple comes down here, and the further Apple goes up from here, the less likely that this will be the objectively best place to buy. It might actually end up being here. The reason that this is the best is because if you are right, the reward is huge, but if you are wrong, you lose a very small amount. So let's say the price comes down here. Your stop loss will have to be below this white line, maybe just below it, because as soon as the price touches this white line, it's signaling that the structure has broken. So it is no longer going from a low to a higher low. It actually made equal lows, which means that the buyers that are aligned in this area was not enough to exhaust the sell pressure of the bears, meaning that the macro structure is compromised. Also, assuming that the fundamentals are robust, it's extremely difficult for the big players to, what people say, fake you out, because they would be going against the macro structure, which is supported by really large sums of money stacked in this area to support the price. So this is how you could get really nice setups as an investor or long-term trader, where the risk to reward ratio is 5-1, maybe even 6-1, and very often much higher than this. The real edge in technical analysis is with these asymmetric payoffs, and the junction point is just one of the many powerful tools in my toolkit. Inside my day trading and investing masterclass, I break this down step by step with real chart examples, and you'll see exactly how I identify structure, manage risk, and build trades with professional discipline. There actually is a slightly more advanced way to determine where those junction points are given a chart with multiple higher highs and higher lows, and from that where the price is likely headed next. So if you want to trade with confidence instead of guessing, then this could be the right option for you. It's over 4 hours of advanced strategies, and I made it as simple as possible so it can be easily digested for beginners as well. You can find the masterclass through my bio and social profiles, and every enrollment directly supports humanitarian relief, so you're not just learning to trade smarter, you're also making an impact.